Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Energy Transfer stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Energy Transfer transports and stores natural gas, crude oil, natural gas liquids, and refined products. To put it simply, it makes money by storing energy and also moving it through its pipeline to various customers. It owns 90,000 miles of pipeline infrastructure. Its assets are in 38 US states and in Canada. The company owns all Sunoco branded gas stations in the US. There are over 7,300 of them. If you only want to invest in just the gas stations, you can simply invest in ticker SUN. SUN's market cap is $3.4 billion. In the trailing 12 months, its revenue is $15 billion, operating cash flow of $552 million, and free cash flow of $416 million. All of these numbers are consolidated into ET's financials. The company also owns USA Compression Partners. If you only want to invest in USA Compression, you can simply invest in ticker USAC. USAC's market cap is $1.5 billion. In the trailing 12 months, its revenue is $631 million, operating cash flow of $282 million, and free cash flow of $241 million. All of these numbers are consolidated into ET's financials. In February of this year, it announced the acquisition of Enable Midstream for $7.2 billion in stock. Enable's ticker is ENBL. It has a market cap of $3.4 billion. In the trailing 12 months, its revenue is $3.4 billion. Operating cash flow of $892 million, and free cash flow of $625 million. These numbers do not appear to be consolidated into ET's financials, but they probably will be next quarter. Energy Transfer is structured as an MLP, a master limited partnership, pays a lot less taxes than a traditional corporation. To qualify, the business must receive 90% of its revenue from natural resources or real estate. The company is headquartered in Dallas, Texas, and was founded in 1996. It trades on the New York Stock Exchange, London Stock Exchange, and Mexican Bolsa. Let's get started with the model. This is a large cap company, 25 billion market cap. They're trading at $9.13 a share, and they have 2.7 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So every year they have positive free cash flow, but it jumps way up to over $8 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that also peaks in the trailing 12 months at over $5 billion. Revenue is the sales for the company, and that dropped a lot in 2020 because of lower oil prices. It has come up to its highest level at $59 billion in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Here's a breakdown of their revenue from their annual report. This shows you 2018, 19, and 20. 2020 was a rough year for oil companies. The price of oil got really low. The most sales is from refined products. This is mainly from their Sunoco gas stations. They generated $9.4 billion from crude sales. This is the sale of crude via its pipelines to its various customers. Natural gas liquid sales was $6.8 billion. Gathering, transportation, and other, that was $9 billion. Transporting furniture or transporting phones is very simple. Transporting oil or natural gas is very complex. That's why they generate so much revenue from it. Natural gas sales is $2.6 billion, and then other $500 million. In every category, it went down from 2018 and 19 to 2020, but it's come all the way back up in the trailing 12 months. I don't have the breakdown in the trailing 12 months. I just have it for the 2018, 19, and 20 years. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was highest in the trailing 12 months. And their gross profit was higher in 2020 than 2018, so they did a good job at managing expenses in 2020. And below that is their operating expenses, then below that is their operating income, which was also highest in the trailing 12 months, so they're becoming really efficient. Here's a breakdown of their expenses from their annual report. Cost of products sold is their biggest, $25 billion. This includes the actual cost of the fuel products. They spent $3.2 billion in operating expenses. This includes payroll, compensation, the cost of insurance, the cost to operate the plants, and also advertising costs. Then next is depreciation, depletion, and amortization, $3.7 billion. This is a non-cash item. Next is SG&A, $700 million. This is the payroll for all the employees that are not working on the actual products, like the executive team, the admin staff, accountants and lawyers also fall into this category. And a company like this usually has a lot of impairment expenses. Impairments is when you decrease the value of an asset on your balance sheet and pass through the loss onto your income statement. It's a non-cash item, so it doesn't affect cash flow. They had a goodwill impairment of $2.2 billion. So in 2020, they wrote down the value of a business they acquired in the past. Goodwill is the premium you paid for a company and you carried on your balance sheet. They had fixed asset impairments of $58 million. An example of a fixed asset for this company is their pipelines. And they wrote down the goodwill of USAC. They acquired this company in 2018. In 2020, they decreased the goodwill related to that company by $619 million. And this company has a lot of equipment, and they passed through an $8 million impairment on some of their equipment. And they do have a lot of debt. Generally, when you invest in an MLP or a REIT, they have to pass through almost all their profits to the investors in the form of dividends. So they don't have much money left over to grow the business. So they need to take on debt in order to grow it. So they paid $2.3 billion of interest on their debt in the trailing 12 months, which is pretty similar to prior years. It was the lowest in 2018 at $2.1 billion. And the bottom line of the income statement is their net income, which was negative in 2020, positive in the other years. But the reason it was negative in 2020 was not because the company was struggling, it is because of these large impairments. Although they did have much lower revenue than most years, if it wasn't for this large impairment, they wouldn't have had negative net income. And you could see how little taxes they pay relative to their pre-tax income. In the trailing 12 months, it looks like about 5% of taxes. That's the benefit of being an MLP. You pay a lot less in taxes. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you can think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they generate lots of cash flow. It peaked in the trailing 12 months at over $11 billion. They always spend a lot in CapEx, property, plant, and equipment, because they have a lot of infrastructure to build out. And they spend between $3 billion and $7 billion a year in CapEx. Operating cash flow minus CapEx gives you your free cash flow. And they generally have a lot of free cash flow, so they do pay a nice dividend. And it does look like they paid down a lot of debt in the trailing 12 months because they had so much extra free cash flow. They paid down about $6 billion of debt in the trailing 12 months. In 2020, they paid down a similar amount of debt as they issued. In 2019, they added about $2.5 billion of debt. They also add capital stock each year, $1.4 billion, $800 million, $1.6 billion, and $900 million. When a company adds stock, that increases the shares outstanding, making your shares less valuable. Like I said earlier, with an MLP, there's not much money left over to fund growth, so they need to add debt and equity to do that. Here's a breakdown of the cash flow from financing section from their 10K. This is for 2020. According to this, they added $24 billion of debt. They paid down $24 billion of debt. They received $1.6 billion of cash from a subsidiary. They paid out dividends of $2.8 billion. If you're a shareholder, you're a partner. In a regular corporation, you're a stockholder. But in an MLP, you're a partner. They also have to pay dividends to their non-controlling interests. These are their subsidiaries. I think this is for Sunoco and USAC. An MLP has no equity on its balance sheet. It has partners' capital. It's pretty similar to equity. They had $27 billion of partners' capital. They raised $5.7 billion from their preferred shareholders, and they raised $22 billion from their common shareholders. If you own ET stock, then you're a common unit holder. Let's look at the capital structure. $27 billion of equity, $46 billion of debt. They're 37% equity, 63% debt. And I gave them the middle whack on Finbox, 11.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $44 billion. We discounted those numbers back to today using the weighted average cost of capital, we get a value of the company of $40 billion. We divide that by 2.7 billion shares. And we get a calculated stock price of $15. They're trading at $9, so they're trading at a 39% discount. It's a buy according to the model. The average analyst projects their revenue to grow 1.5%. So to get their future revenue estimates, I grew at 1.5% for the next 4 years. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, I divided by these 4 revenue numbers. And that comes out to 6%, so I multiplied their future revenue estimates by 6%. That's how I got their future free cash flows. All these numbers are well below their trailing 12-month number, so I think it is a doable estimate. I'm still coming out of the stock price a lot lower than they're trading at. I think the price isn't as high as it should be because of all the debt they have. Simply Wall Street is way higher than me. They're at $23 a share. They're saying it's 61% undervalued. 4 analysts priced this stock and the average price target was $15. The reason people invest in MLPs or REITs is for that dividend payment. They pay a nice dividend, almost 7%. And they were paying 31 cents a share, but the stock price has come down a lot, so they cut it to 15 cents. But it's still a pretty hefty dividend payment, which they can easily afford. That's 33% of their net income, 20% of their free cash flow. And their industry pays a 4.6% dividend, so they're a lot higher than their industry, and analysts are projecting their dividend to grow to over 7%. This is where the stock has been trading the last 5 years. So you can see it was trading much higher, close to $20 a few years ago, but it kept coming down little by little. When the price of oil future contracts turned to negative, pretty much all oil stocks crashed, as this did. You can see it got really low. It has come up since then, but not that much. It's still trading well below its pre-crash highs. This bottom chart is the price of oil. So you can see the price of oil moves fairly closely with ET stock. They both crashed at the same time, but oil has come up a lot since the bottom. It's over $80, past where it was 2-3 years ago. But the price of ET is still well below the price it was 2-3 years ago, so it looks like there's a lot of upside potential for this stock. This is a really volatile stock. It has a beta of 2.29, so the stock moves more than 2 times the market. It's gone up 68% in the past 52 weeks, while the S&P is up 29%. The 52-week low was 537, the high was 1155, and the stock is trading below its 50-day and 200-day moving average. This is a very popular stock. Nearly 20 million shares have been traded on average the past 10 days. Of the 2.7 billion shares outstanding, 2.3 billion are on float, 37% are held by institutions, and 3.5% of the shares on float are shorted. Some investors look at employee count, and their employees have actually decreased. It was a lot higher in 2015, 16, 17, and 18. Then it dropped a lot in 2019 and 2020. But they're generating more revenue in the trailing 12 months than ever. So that's why they're so profitable. They may be cutting inefficient parts of their business and just focusing on more profitable ones. That's why their employee count is lower. They're at 11,400 employees. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $4,800 today. That's pretty much a 50% loss. Pretty much every oil stock we looked at, if you invested 10 years ago, you would have had a loss today. Because you really have to time it right when investing in a commodity like oil. So if you bought it 10 years ago and sold it after 1, 2, 3 years, you would have made a great return. But if you held on, you would have lost a lot of money. But if you bought the stock 1 year ago, you would have been close to doubling your money right now. But it seems like a good time to buy oil stocks because look how low the prices are. I think there's a lot of upside potential. The only insider activity is buying. There's no selling. So a lot of people are buying this stock. The CEO, Kelsey Warren, bought 1 million shares, then 949,000 shares. And the stock is trading at $9.13. He paid more than $9.13. So you could get a better deal than the CEO if you buy the stock today. The biggest shareholder is the CEO, Kelsey Warren, at almost 10%. His valuation is $2.4 billion. Ray Davis, the ex-CEO and current owner of the Texas Rangers, owns 3.2% of the stock. Then Blackstone, Harvest Fund Advisors, and Invesco. Let's look at their financial ratios. They have amazing price multiples. A PE below 5, it's unbelievable. Below 15 is considered a great deal, and they're below 5. That means investors are paying $5 for $1 of net income. PE is stock price over earnings per share, or market cap over net income. They have an amazing price to sales, also 0.4. So that means their revenue is more than double their market cap. A price to sales of 0.5 means your revenue is double your market cap. Below 0.5, it's more than double. And a price to book of 0.9, which is also really good. Price to book is stock price over book value per share. And the way you calculate book value per share, it's equity over shares outstanding. Equity is on the balance sheet, it's assets minus liabilities. They have $27 billion of equity, $19.5 billion of tangible equity, since they have $8 billion of intangibles on their balance sheet. A company gets intangibles on its balance sheet when they acquire another company. So you can see this is goodwill and other intangible assets. They have a good ROIC of 11.1%, which is lower than their WACC though, so I prefer to see an ROIC greater than the WACC. They can cover their interest payments almost 4 times. Even though they have a lot of debt, they can easily cover the interest payments because they bring in a lot of revenue. Their ROE is 19%. A company with lots of debt can inflate their ROE. Their current ratio and quick ratio are below 1. If a company has a current ratio below 1, I'm not too concerned unless they're not bringing in a lot of cash flow. If it's a startup that's not bringing in much revenue and they have a current ratio below 1, that's a big red flag. When a company has so much cash flow rolling in, I'm not too concerned. They have $300 million of cash on their balance sheet, $6.5 billion of receivables, and $1.8 billion of inventory. So they do seem to be well capitalized because they bring in so much cash flow. They had over $8 billion of free cash flow in the trailing 12 months. Such a huge number. They have negative $785 million of working capital. Working capital is current assets minus current liabilities, and they pay out $1.7 billion of dividend payments. So they have $5.7 billion of funding. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 45 companies in the same industry as ET, and ET's price multiples are unbelievable. So much better than the average. Much better PE, price to sales, and price to book. Their current ratio is below 1 and the average is 1.2, so they are doing worse than average in that category. They're higher in ROE, they're pretty much average in debt, and they are considered one of the larger midstream companies at $25 billion market cap. And their dividend is higher than average. So to summarize, I have them trading at a 39% discount, but ever since I started this channel, I've always said I've been really bullish on this company. I think they're one of the better midstream companies. They also do some downstream because they have the Sunoco gas stations. You can't get more downstream than that. The closer the oil gets to the end user, like when it gets to me and you when we pump the gas in the cars, that's a downstream. That's the very bottom of the downstream. The upstream part is the exploration and production. Upstream companies identify where the oil is and then extract it. That's the riskiest part of the process because it's very expensive, time consuming, and there might not be any oil at that location. Or it may be so costly to pull the oil, it may not be worth it. Midstream is the least risky part of the process. Midstream companies just transport and store the oil. They're between upstream and downstream. Some companies do all three, upstream, midstream, and downstream, like BP for instance. But this company is mainly midstream, although with the Sunoco acquisition, it is doing some downstream. But if you're a midstream company, you can't really get into upstream. It's a different animal. But if you're an upstream company, it's a pretty smooth transition to midstream or downstream. That's why midstream stocks are getting so popular these days because they pay really nice dividends. Lots of them are MLPs, and the risk is pretty low when investing in them. It's unlikely they're going to go bankrupt, and they're going to always have business. Upstream companies always need them to move oil from one party to another. So if you find a right midstream company for long-term investment, it's a great thing because you're cashing your dividend payments. Some people have commented on some midstream stocks that they've owned it for 10, 20 years and their dividend is now over 100% because they bought the stock at such a low valuation many years ago. I ranked their free cash flows, revenue, and ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.